you have a report that suggests that we are not entering another crypto winter. What indicators support that view despite recent market turbulence?
Yes, exactly. There is still quite some controversy around whether the historical 4-year cycle, that this would repeat itself again, leading to drawdowns into 2026. And we have seen crypto-specific events very much on the liquidity side as well, such as the historical liquidation event on October 10th. If we, however, look at the fundamental data, be that on the macroeconomic side with the business cycle, the interest rate cycle, inflation pressure, but also on-chain economics, then we see that the fundamentals are not only still strong, but rather still improving.
Considering the geopolitical situation that we're facing right now, how do you think it could influence investment flows into crypto or tokenized assets and digital finance infrastructure in general?
That is truly an interesting question because
Hi, I'm Dr. Lorena Nessi for CCN. Today, I'm joined by Fabian Dori, Chief Investment Officer at Sygnum Bank. We will discuss the macroeconomic forces shaping digital asset markets, the growing institutional investment in blockchain infrastructure, the rise of tokenized financial assets, and how geopolitical tensions could influence the next phase of crypto adoption. Hi, Fabian. Nice to see you. Welcome to CCN.
Hello, Lorena. Thanks for having me.
Thank you. I'm looking forward to this conversation. So we're going to start straight into crypto. So you have a report that suggests that we are not entering another crypto winter. What indicators support that view despite recent market turbulence?
Yes, exactly. Our hypothesis is that the current market volatility is more caused by liquidity and by sentiment than by fundamentals that would be deteriorating. And that hypothesis, I would say, is well substantiated if you look at the data, right? We see, for example, that overall crypto markets have been put on thinner ice for quite some time by the fact that there is still quite some controversy around whether the 4-year cycle, the historical 4-year cycle, that this would repeat itself again, leading to drawdowns into 2026. So I think that just led to marginal supply being a bit higher, and with that, the market being, so to say, on a thinner ice. Then we have seen crypto-specific events very much on the liquidity side as well, such as the historical liquidation event on October 10th that significantly reduced the risk appetite both by investors but especially also by market makers, and then led to less supply from them and again lower liquidity. But then also concerns around the store of value characteristics, mainly of Bitcoin, because of quantum risk or quantum computing risk, because of concerns that if the drawdowns continue, digital asset treasury companies would be forced to sell some of their exposure. And last but not least, obviously, the delay on the regulatory side. So this all led to, on the one hand, deteriorating liquidity conditions, but also heavily impacting sentiment. If we, however, look at the fundamental data, be that on the macroeconomic side with the business cycle, the interest rate cycle, inflation pressure, but also on-chain economics, then we see that the fundamentals are not only still strong, but rather still improving. And as you outlined, that gives us the confidence that our hypothesis that we are not entering into another crypto or even an ice age, that this is not the case.
Okay. And considering the geopolitical situation that we're facing right now, how could higher oil prices and energy market volatility, how do you think it could influence investment flows into crypto or tokenized assets and digital finance infrastructure in general? Do you have any views about that?
I think there are two parts to that, to the answer to this question. On the one hand, so to say, how do the geopolitical risks directly impact the market price action? And I think that is a bit a more tricky answer to give, because in the short term, obviously, an increase in oil prices has a negative impact, again, on liquidity conditions. At the same time, and on inflation pressures, and then ultimately on interest rate decisions. So I think that is in the short term rather a negative factor on risk asset prices. At the same time, and that's interesting to see, right, how now crypto assets, and not only Bitcoin, but I would say the broader space, has actually positively reacted to the recent escalation, especially on the geopolitical front. So that storyline around Bitcoin being a long-term store of value, having characteristics that hedges it against, or that help to hedge against inflation pressure, against geopolitical risks in a medium to long term, there still seems to be substance to that. And in line or supported by the fundamentals that I mentioned before, we think that short-term volatility remains high on the price front side, but mid to long term we see a gradual improvement on that side. Now, the second part of the question relates to the infrastructure per se, and I think that's also very interesting to observe, because most recently, and maybe a bit different to earlier cycles, institutional adoption is much less about price exposure and much more about institutional integration, building the infrastructure, being able to build the infrastructure to tokenize, to issue and manage stablecoins, to have real-world assets on chain, tokenized money market funds, but also tokenized securities and so on. And it's interesting to see that despite the volatility that we have seen early on in the year, more on the price side and now also on the geopolitical side, that this adoption very smoothly continues.
Well, I hope that is good news for everyone. But what about in the specific case of Dubai? You know, Dubai has this ambition to become this global crypto hub for real-world asset tokenization. And it depends, obviously, in a lot of investor confidence and cross-border capital flows, political stability. And now it is not looking like that. So do you think these tensions could undermine Dubai's ambition to become this global hub for tokenized real assets?
Yeah, I think that is probably too early to give a conclusive answer. But the hypothesis, again, is that there might be some short-term volatility, and we see that. But the longer-term trend is very much shaped by regulation, by the competences, the talent being around to build the infrastructure, to further innovate the space. As you mentioned, also the capital flow, obviously. And I think the overall consensus regarding, so to say, the situation is that it should normalize at a certain point in time, given all the dependencies that they are. We mentioned the oil prices earlier on, but also other supply chains that are getting more tricky and so on. So I would say there is probably a bit of a short-term volatility to that adoption journey, but the longer-term factors, regulation that advances, talent that is attracted to build and to innovate, capital flows and so on, I have no signs of fundamental disruptions on that side yet. Yeah, so I would not expect it to have a lasting impact. Unless, obviously, it would really be a significant disruption over a longer period of time. No?
Yes, of course. Of course, there's always this uncertainty side of it, right? But talking about this actual global uncertainty in terms of Bitcoin, do you think Bitcoin behaves more like a risk asset or a safe haven asset?
Yeah, that is truly an interesting question, because I think it's a bit both, right? As we have seen, especially over the last couple of months, Bitcoin has not really lived up to its use case to be a store of value and a hedge against exactly geopolitical risk, political risk, and so on. But I see it as a reminder of the fact that in the shorter term, Bitcoin acts as a risk asset, given its liquidity, given the fact that it's tradable on a 24/7 basis, but also given the fact that it's still quite some speculative exposure in that asset class, and speculative exposure very much reacts to exactly those points of those volatility points, right? So that is the short-term nature. Here I see really the risk asset behavior. The mid to long-term behavior, however, there I see still signs that Bitcoin continues its journey as an ever more accepted store of value, and a store of value, so to say, on the system itself, a hedge on the system itself, because we see that the integration with the traditional banking system, with global asset managers, sovereign wealth funds that are investing and so on, we clearly see that this store of value characteristic, Bitcoin as a collateral asset as well, and ultimately Bitcoin as a yield-bearing asset, that this journey continues. So in the mid to longer term, I would say yes, the use case of Bitcoin as a store of value gains further traction.
Well, I'm going into Sygnum's report that suggests that there is 1 in 10 bonds that could be tokenized at issuance. So what conditions are necessary for tokenized securities to become mainstream financial infrastructure, you think?
There are a number of dimensions that need to be fulfilled. First of all, the regulatory side. So it must be clear what is a tokenized asset on chain, right? What is it? What is it? What regulation is around it? Who oversees it? What tax implications there are? All those aspects. Second, beyond regulation, the infrastructure needs to be in place, such that issuers, investors, custodians, etc., but also secondary market, etc., have access to the instrument itself, can custodize it, can trade it, and so on. So the infrastructure is a second dimension, and third, exactly that there is also liquidity in that market, right? If so to say, the regulation is there, and if the technology is there, that is not a guarantee yet that so to say that asset class of tokenized bonds, or more broadly tokenized real-world assets, is really taking off. We have seen that on our end very much so in Switzerland, right? Switzerland has been very early on and innovative in terms of providing the right regulation for tokenized assets. We have seen technology being built up and built out quite significantly on a very mature level. But the use case of it, the institutional demand for it, is only now emerging. So with the ecosystem growing large enough such that there are a sufficient number of issuers, investors, and institutional entities that participate in the value chain.
Okay, good. You talked about custody and, specifically talking about self-custody. Do you think it will be the dominant model for digital assets ownership, or will institutional custodians remain central to the ecosystem?
I would see it a bit similar, so to say, to the traditional space with cash and then maybe asset holding at banks, right? So there's probably a certain amount of assets that will be really truly held in self-custody exposure or in self-custody solutions. That is, however, associated with certain challenges. So one needs to make sure that not only yourself have access to it, understand the complexity around it, that there's backup, that you can include it into your tax reporting and all those elements, which leads me to the hypothesis that the major part will be held with maybe not central depositories, but with regulated institutions that provide the right security process framework around it to ensure safe custody, but also enable then value-adding services around it, such as, for example, a tax report, or the more sophisticated like lending and borrowing activities, etc. So I truly think the major part will be with regulated compliant institutions, and then a certain part probably still held in self-custody.
Okay, good. Well, you seem optimistic about the future of crypto in general, and all these infrastructure behind also playing into the field of decentralized and centralized entities. But let's try to think about the future, like looking ahead. How do you think that these shifting dynamics that have to do with the actual geopolitical tensions, but actually where the history that we have seen happening with these assets is going to shape the global role of tokenized assets and digital finance, let's say, over the next 5 to 10 years ahead?
Yeah, that's a key question. We have the hypothesis that in the long term, all assets will be on-chain and tokenized because of the advantages that come with it, such as, again, 24/7 tradability, cost efficiency for cross-border transactions, near-time settlement, but also, and I guess that's the most important part, the programmable value chain, which then allows to really automate, integrate and automate a significant part of the value chain and ultimately manage it through, at least in parts, through AI agents. But this is a journey that will take some time, right? The immediate use cases that we see are clearly stablecoins and tokenized assets. I think on the stablecoin side, the debate and the controversy has already heated up a bit, first through the Genius Act and now also through the Clarity Act deliberations, where it becomes very evident that traditional banks are concerned that stablecoins and tokenized money market funds may become, so to say, the default balance, and then obviously really have an impact into the value chain and mechanics of a traditional bank. So I think the journey is really only starting, and but ultimately, for us, it's clear that all assets will be held online on chain, and the value chains to a vast part be automated.
Well, we will see. Certainly, Switzerland is playing a leading role in that process, isn't it?
It is, yeah, definitely it is. But we clearly see that the regulation is in various other jurisdictions also significantly advancing. We have seen the European Union with the MiCA regulation. We have seen advancements also very much so in Hong Kong most recently. And then I think what has been, so to say, an inflection point has been the changes in the US throughout last year, which really, I think, so to say, started off a bit of a regulatory race. Yes.
Yes, well, it's always a chasing game, right? Regulation trying to catch up with technology and, trying to shape things as they go. But technology is just going so fast. And as you said, AI now it's into the game, right? So that will probably shape it in astonishing ways, I expect.
Yep, definitely. And here again, I think the blockchain technology is, so to say, very well suited to integrate with AI, because there's a lot of data on chain. There are structures to be analyzed and so on. But most importantly, through smart contract platforms, AI agents have the ability to read also, so to say, mechanically interact with blockchain, initiating transactions, monitoring flows, automating value chains, and so on. So I think that the blockchain technology is actually one of the necessary preconditions for AI to really have an impact on the real world financial infrastructure as well.
Yeah, absolutely. Yeah, a huge. I was going to say it's like a marriage, but I don't want to put it in such a light. But definitely, blockchain and AI, they need to be together like that. That's for sure. Great. Well, Fabian, thank you so much. Is there anything else we should add to our conversation before we say goodbye?
No, I think that has been very interesting, comprehensive discussion. Thanks a lot. Yep.
Thank you. Thanks for joining us at CCN, and we'll see you next time. That's Fabian Dori from Sygnum Bank, and I'm Lorena Nessi, and see you later.